Hope everybody's doing well. It's kind of rainy here in Atlanta. It's been like this for most of the week, and I think it's going to go on until the weekend. But I hope everyone is doing well. We're going to go ahead and get started here. Just want to make sure everybody can see my screen, see my cursor. Good. I have 4 screens here I'm looking at, so I have to figure out which one I'm going to use. Okay, so the state of the markets 2023. Here's our little information there. We've got a few formalities here. All that, our address, and also any information that I'm sharing today are my views, and they're not Cetera's views or anybody else's views. So you can't blame anybody but me. And also, you cannot invest directly in indices. We'll have another reminder about that here in just a second. And questions are welcome, as you always know. If you have a way to, I guess at the bottom of your screen, there should be a Q&A box down there, and you can just enter the questions there. And then I'm told that I need to do those at the end of the workshop, just so they have to edit them or something. So what we're going to talk about today is obviously first what happened last year in the markets, and then what we can kind of expect going on this year and for maybe the next 18 months. Obviously, today's a big day because we're all awaiting the decision by the Federal Reserve Board whether or not they're going to raise rates by 0.5 point or 1/4 point. Most of the market, with 99% of everybody, is expecting a 25 basis point rise, whereas I wouldn't be surprised to see a 0.5 point today. But let me start with something that I wrote back in July of 2021. You probably remember this if you've been reading my letters. I know Ted, Al, you're out there. Lynette, hopefully you're listening too. The more I look at this chart, this is in what I said in 2021, I'm convinced that we're in something disastrous in the NASDAQ, just as in 2000. So a 50% drop, probably. And if you look at what's happened since then, yes, we have had a 30% drop. Actually, it's been like 33. That's how that was the performance of the NASDAQ last year. And you have to ask yourself, do we see more of a drop to come, or are we expecting, maybe a reversal here? So we're just going to have to see how that plays out. But I'm expecting a further drop, and I'll explain to you why in just a moment. But anyway, let's go forward then and take a look at the S&P. You can see this is where we had the pandemic scare, and then a lot of money was printed and a lot of stimulus, and we had a massive run up after that. And then since then, we've had a turnaround. So that's the S&P for the last 10 years. Here you can see it for the last 5 years. And you can see here that there's a lot of investor traps. So these are like false positives, if you will. So, we're down, and then all of a sudden, oh, that looks good, and people buy in, and then oops, lost our money, and oops, back up again. And so we've had a little bit of a pickup here in the last few months. Couple of months here, so really in the last month or so. So, the question is, where do we go from here? I think that's everybody's question. Here's taking a look at the Dow. You can see the Dow had a significant drop all the way back down to below 20,000 during the pandemic, and then since then it's been pretty resilient. So the Dow, out of all the indices, has probably performed the best, even better than bonds. I'll show you that in a second. But if we look at this again, you had a lot of sort of false positives where, this was this an up? No, it wasn't. This is an up? No, well, maybe. We'll see how it goes from here. But if we take a look at, all of the indices together, we can say 2022 was pretty painful for everybody. The one thing I do want to point out, though, is the Bloomberg US bond aggregate. Now, for people who have 401k plans, and you've seen these target funds where you'll have a target 2040 date or a target 2030 date or whatever it may be, for people who are nearing retirement and they're in these 401k plans, really the most conservative portfolio that they have, other than maybe a stable value fund, is this Bloomberg bond aggregate. And over the years, I've watched it, and no bond manager can consistently beat the bond aggregate. It's not possible. No one's done it, even Bill Gross. But if you look at what the bond aggregate did last year, all those people that were in the most conservative portfolios, they were down 13%, and that's pretty painful. I can see people going from $1 million down to 870,000. That's $130,000 to lose. So pretty painful there. Now, because I have talked about indices, we have to have these disclosures about indices, and I think the bottom line here is that you can't you can't invest directly in an index. There are many ETFs, mutual funds, and other things that people do to try to mimic those, but we use these indices to sort of gauge where the market is and the general asset classes. So one of the things that I always look at when we are talking about what the market has done and what we can expect it to do is to look at the money supply. But I noticed that there's a lot of confusion about what money is. And so I just, like my guy, JP Morgan, back in 1912, talks about gold as money. Gold is money, and everything else is just credit. I just read an article just 5 minutes ago about how China and other countries have bought massive amounts of gold. And if they're concerned about their currency, or they're concerned about the international market, or obviously you've had massive inflation all around the planet, and I'll show you that in a second, then people still buy gold. And we thought, or we've been told that gold is out of use. And we were told that mainly by a guy named John Maynard Keynes. And I always try to set the case here, because if you look at the economy that we're in a Keynesian economy, which means that we print money to cover our problems, which pretty much that's what we do for every single problem that we have, economically speaking, because we just print a bunch of money. The Austrians, on the other hand, lived through the Weimar Republic, and they saw the detriment and the destruction that unfettered printing can do. So if we look at gold money, which was a very basic, stable, fundamental money for thousands and thousands of years, the Romans used it, the Ottomans used it, the Chinese used it. I mean, everyone has used it. And when they run out of gold, then they just start printing money, or especially when they need more money to spend on things. So we went from gold money to gold standard. Those things are pretty honest. And then we went to fractional money, and then we went to complete fiat money, and that's where we are today. So you can go back to the Roman Empire, the Chinese Yuan Empire, all the Middle Kingdoms. I mean, whenever they had a king that came in and made a stable currency backed by gold or silver, the empire did very well. Whenever they started debasing the currency, then eventually there was a collapse in every single case. There were other reasons too, but that's definitely a corollary. So when we talk about Keynesianism versus Austrianism, we do not have the joy of living in an Austrian economy, and it's almost like just impossible to do, because people, mainly governments, always run out of money. You're notice that they always run out of money, and they always need some more. And the easiest way to do that is to just print it, because they can. They have the guns, and no one else can do that. So let me just back up a second here, and let's talk about this, because I want everyone to understand it. Gold money is what it's always been, okay? And then we have the gold standard, where, well, the Templars are the ones that during the Crusades, the Crusaders were going to the Holy Land, and they would leave France and head down to the Levant, and they didn't want to take all this gold with them, mainly because there were a lot of bandits on the way, but also because it's heavy. So the Templars came up with a plan that, hey, we're going to create this piece of paper over here in France. You give us our gold, you take this piece of paper to a Templar consistory over in the Levant and Acre, or wherever it may be, turn in your paper there, and then you have ciphers and everything that the bandits can't read, and they think it's worthless. So when they decode it over in the Levant, or in the Jerusalem area, they're going to redeem their gold. So it worked out really, really well and made the Templars very wealthy. So the gold standard is honest, because you had one piece of gold for one piece of paper. The problem comes in, and I think this is the Medicis that figured out that, not everyone comes to get their gold. So we can print a whole bunch of pieces of paper basically on the same piece of gold. Well, you can see how that's fundamentally fraudulent. So, if every single one of these people with every single one of these pieces of paper came back to get their pieces of gold, there would not be enough gold. And that essentially is fraudulent. And to make the fraud even worse, we basically just substituted the gold with other pieces of paper. So now we have pieces of paper that we're trading for pieces of paper. And, if you want a big piece of paper, then you get a bond or a treasury. And then if you want to use small pieces of paper, to eat here and there, buy some groceries or whatnot, then you use the smaller pieces of paper. And that's where we are. And so pieces of paper can just create more pieces of paper. And now it's even electronic. So we don't even need to have paper. We don't even have trees. We just have computer chips and silicon. So that's how that goes. I want to explain how the Fed works, because this country went a couple of hundred years without the Fed. And since we've had the Fed, it's just been destructive. People don't realize, and I know there's a lot of supporters for the Fed, because when I went to school, everyone talked about, we got to have the Fed. It's sacrosanct. We got to have it. No, we don't have to have it. In fact, it's ruined our currency. What happens is the Treasury creates these treasuries, or again, it's just electronic, and then the Fed creates these dollars just out of nothing, just electronically, and they hand those back to the Treasury. So then the Treasury now has these dollars electronically, and boom, all of a sudden it shows up in your checking account as Social Security, or the Pentagon gets the money, or Medicare, Medicaid. We give it to foreign countries. We're giving a whole bunch of it to Ukraine. And then finally, no, we're giving it out to the public and this and that for that reason. So, that's how it is. That's how it works. And the problem is that the more dollars you create, it dilutes the dollars that are already been created. And those are the dollars that you and I have to work for. Invest, risk, right? Risk for investment, and pay taxes on. I get upset about it. But when we're talking about dollars and we're talking about massive amounts of money, I think it's important to put it into perspective. Because I don't know if any of you have ever been to the Luxor out in Vegas, but if you're walking through the hallway, they have a plastic box there, and inside that plastic box, they have $1 million in cash. And it doesn't really look like that, like a whole lot. It's $1 million, but it doesn't look like a whole lot. In fact, you can see this guy right here. All these guys are the same person, so it's just all kind of the scale. But $1 million is just something, that'll fit in maybe your glove compartment. But then here's $100 million, a larger, that may fit in your bathroom. Okay, well, here's $1 billion, 10 of those, and you may be able to stick that in your garage. But then look at $1 trillion. Okay, that's the same guy, but now he's way down in here, and you can see all of this massive amounts of money. So when we talk about $1 trillion, and we throw that number around here and there, we're talking about an astronomical amount of money. That's something that none of us really can get our brain around. Now, the reason that we haven't had the inflation that we've had in 2008, because when they did TARP and all of this money printing, they basically left it at the bank level. This time it was different. Most of the money went out into the public, and that has caused a problem. But if you can see, this is our dollar, essentially our money supply for the US, and we're well over about 22 trillion. And you can see it's just been created, it's just, and here recently since 2020, it's just been almost vertical. And you can see there's been a little bit of a pullback here, which is, essentially been the Fed trying to reduce inflation by unwinding the balance sheet. And I'll show you how much money the Fed has right now. But the thing that really concerns me is something that John Maynard Keynes himself said long ago. There's no subtler, no surer means of overturning the existing basis of society than to debauch the currency. So I don't think we're there yet, but you definitely see people struggling. You see prices in the grocery stores. You see people, begging on the corners. We never saw that in Brookhaven, never saw that in Dunwoody, but now you do see it, and you see children out there with them. So you don't know if those are, immigrants, or if they're just Americans, or whatever they are. But it's kind of depressing. So part of that has been because of all the massive inflation that we've had. So, if we look at a history of inflation going back to 1960, obviously the 70s and 80s were really rough. And the reason for that was the Vietnam War and our uncontrolled spending during the Vietnam War. And up until 1971, we were still on the gold standard. So once we came off the gold standard, then that's when, Faulkner came in and raised rates very high to fight inflation. But you can see, and again, this is based from a source at the World Bank, so I would not believe it, but I think it's got to be some sort of corollary to the truth. You can see we've had, worldwide. Oh, well, this is the U.S. We're up. We've had some inflation too. In fact, the CPI, which is the formula that is, I guess, invented by the Bureau of Labor and Statistics. Originally, we used it back in pre-1980, but they changed it in 1980 and they changed it again in 1990, essentially because they didn't like what it showed. So if you see the red line here, that's the official one that we're using today, whereas the blue one is the one that we used back in 1990. So you can see based on the 1990 numbers, we're at 10%. But they changed it again in 1980. So if we go back to then, the 1980 based, which they changed in 1981, excuse me, you can see we're actually closer to 15%. And why are these so different? Well, it depends on how they categorize things and what they consider essential things, and then whether they put in energy or whether they put in food and stuff like that. They also change the category of stuff. So where the blue line may be, oh, that's steak. Okay, the price of steak is inflating. Well, the red line, well, it's not steak, it's ground beef. Okay, so essentially they're saying that ground beef and steak are essentially the same thing, right? But you and I know that that's not true. We can go to a restaurant today and I can show you the price difference between a hamburger and a New York strip, and it's significant. So they're just playing games with us. And the word on the street, this is what I've heard again, is that they're getting ready to change this again. So, when the numbers look too bad, they just change the numbers and change the chart. So I guess they think it's like Pravda and we're just Russians that believe this stuff. But I've been to Russia, I know the Russians, and they don't believe anything Pravda says. And that's about where we are, I think, with our government, certainly with our media. So here's 14 decades of price inflation. This is actually since 1870. You can see between 1870 to 1914, when the Fed was created, essentially, we had no inflation. In fact, we may have had a little bit of deflation in there, which is good for you. If you're holding money, then that means your money buys more things. And I don't know why people think that's a bad idea. It's only bad for people who are selling things and holding on to large inventories, but that doesn't happen so much anymore today. But if you look at the Federal Reserve back in 1914, that's when they came into business. Originally, it was going to be called the Aldrich Act after Senator Aldrich, but that didn't go so well. That didn't go over. So they had to come up with something that sounded better. So they came up with Federal Reserve Bank. But there's nothing federal about it other than it just controls all of our money. There are no reserves. All the reserves are just created, and it isn't a bank. It's just, it's really just a cartel. So in 1933, we abandoned the gold standard. Basically, Roosevelt made gold illegal to own. So if you owned gold, you had to bring your gold down to the Federal Reserve Bank and trade it in for, guess what? Some paper. That's right. You had to trade it in for some paper. So between 1933 to 1971, we had what at the time was massive inflation for us, because the price of gold was set during the Bretton Woods Agreement after World War II. Guess who was there? John Maynard Keynes. That's right. And also Henry Dexter White, if you remember him. They met in Bretton Woods up in, I believe it was in New Hampshire, and decided that they were going to peg gold to $35, or peg the dollar to an ounce of gold, $35. So they did that. And then after a while, after we started spending so much and devaluing our dollar, the Europeans were coming over here with their money, changing it to dollars, buying $35 worth of gold, shipping it back to Europe, and then turn around and selling it for $75 there. That's what was happening. So, I mean, people blame Nixon for this, and he's certainly one of my least favorite presidents, but it's really not his fault, although I'd like to blame him, but it really isn't his fault. To be completely fair, he had to do it, and I would have done it too. But the other thing I would have done would have gotten rid of the Fed, or at least put some, I mean, it's just disastrous what it's done. I mean, look at this chart. Okay, so the gold window closes, and then guess what? In 1982, the Bureau of Labor Statistics began changing methods to calculate the consumer price index because we just did not like the way it looked. So basically, let's lie to the public and pretend like it's not happening. That's what communist countries do. Now, look at the inflation. I mean, this is all over the world. So it's not just the United States. I mean, if you look, and again, these are official numbers. So if you look at the United States, 7.7% was our official number last year. Brazil, believe it or not, was 6.5%, but I know that's false. Venezuela, 156%. And of course, the perennial leader, Zimbabwe, 269%. I believe one of these countries, I can't remember, Colombia or Venezuela, not Venezuela for sure, but one of those, Ecuador maybe, put their currency on Bitcoin. So they changed their currency to Bitcoin. And if you've been following Bitcoin lately, it's just not had a really good, I think it went from 65,000 down to 20,000. So I don't know where it is today. Ukraine's had 26% inflation. Russia's obviously had a lot of inflation. China, relatively low. But again, the numbers coming out of China are always false. You can never believe those. But I guess that's pretty universal now. So that's been a global theme. In fact, I just read an article that 40% of all of the money in existence today has been created since the pandemic. Think about that. 40% of all the money in existence today has been created since the pandemic. No wonder there's massive inflation all over the globe. There's no, people ask me, well, where isn't there inflation? Well, Paraguay, Uruguay, Bolivia, that's it. But they don't have Chick-fil-A's there, so I couldn't live there. John Maynard Keynes, again, by a continuing process of inflation, government can confiscate secretly and unobserved an important part of the wealth of their citizens. Well, you could do it unobserved if you were just doing it little by little, 2-3%. Nobody was really going to complain. But 10%, 15%, 30%, people start getting out in the streets. 100%, people are rioting, burning down things. So it's not really the way you want to go. Okay. Now, obviously, we've had inflation because of all of this money printing. Let's talk about interest rates. Interest rates are going up. They're going to go up today. We don't know how much, 25 or 50 basis points seems to be what's reasonable. But if we look at, the last 65 to 1965 till today, you can see interest rates have been kind of all over the place. And basically, they spike and then they reverse. They spike and they reverse. They spike and they reverse. And they spike right before we have a recession. And lo and behold, right after we have this recession, rates are lowered again. So if you look at this chart and really studied enough, just prima facie from the chart itself, you can see that they do not know what they're doing, because there is no reason why you would raise rates and reverse them so sharply if raising rates was what you should have done. Okay, I'm not saying they shouldn't raise rates. I'm just saying they should do it very gently, very slowly over a long period of time, and not so dramatically. And the reason for this, I'm going to show you in just a minute, is the bond market. Well, you can see if we zero in just in the last 10 years, 20 years, there was our rate hike, there was our recession. Oh, drop rates back down. Here's our rate hike. There's our recession. Drop rates back down. There's our rate hike. Well, there's our recession. COVID caused, but I guarantee you, had they kept going, the recession would be there too. But here we go again, pretty straight up. Looks like the 2006, 2005 rate hikes. So straight up there. How high are we going to go? I don't know, but this was the point that was required to crash the market then. This was the point that was required to crash the market in 2008, and we're not far away from that. So I don't think we're going to make it very far past 5% before this thing turns around on us. When? I do not know. No one knows. No one can know. And that's the point of Austrian economics. Is Austrian economics says people are not smart enough to figure out what's going to happen with billions and billions of people making trillions and trillions of transactions, things that you and I wouldn't do. Have you ever been on the highway or been in a parking lot and you've seen a car that you just thought was atrocious? Somebody bought that car. I just saw one the other day at Publix, the ugliest car I've ever seen in my life, brand new car. And someone paid good money, probably made $30,000, $40,000 for it, but they liked it enough to buy it. And I just thought it was atrocious. But that's how it goes. Everybody has differences, and it's your value is where you put your money. My value is where I put my money. That person put their value in that disgusting car. And that's just how it goes. But no one, no committee, no computer, no group of people can come around and determine what the right interest rate should be, because it's market driven. And when you try to manipulate interest rates, which is what you're doing, you're manipulating the supply and demand of money. It's market manipulation. And one market that is manipulated and has been hurt is the bond market. because bonds and rates work inversely to each other. You think of them as sort of a carousel or a merry-go-round where, bonds are on one side, interest rates are on the other. So if interest rates move up, bonds will move down in price. Interest rates move down in price, bonds will move up in price. And the longer the term bond, the more dramatic that move will be up or down. So that's why that bond aggregate has done so poorly, or did so poorly last year, down 13%, because rates rose roughly 5% and very quickly. So one of my pet peeves, obviously, is the national debt. And I don't know if you have a chance to check this, but it's the usdebtclock.org. There's one big one in New York in Times Square, if you're ever there, just to remind everybody how much all this is costing, I guess. But if you look at the U.S. national debt, I mean, we're over 31.5 trillion. 31.5 trillion. Now, remember that $1 trillion I showed you that would not fit in your house or your garage, or you'd have to get a warehouse for that. Now we're talking about 31.5 of those. So, I mean, I think it's just a kind of a joke at this point. No, we're never going to pay it off. In fact, we just keep adding to it. And if you go to the usdebtclock.org, you can see this in real time, all these numbers moving. And it would be exciting if it were, money that we're getting, but when it's our debt, it doesn't look good. And you can see that we're basically, 30.5 trillion. So $30.5 trillion in public debt. And it's just been off to the races. And all that's going to happen is that we're going to have more of a deficit, and they're just going to apply the deficit to the debt. And then they're just going to print more money to cover the difference. And that's just going to cause more inflation. And that's going to cause more debt. And they're going to raise the rates. And then the rates on the debt are going to cause more debt service, which is going to cause more debt. I mean, you see where I'm going with this, right? This is a never ending, it's a self-fulfilling cycle here. So until we turn this thing around, I do not see, I don't see the dollar lasting very much longer. I'll be honest with you. I know that's dramatic to say that, but look at these numbers. 30-something trillion, and those numbers are not going to go down. Now, here's the amount of debt that's owned by the Federal Reserve, right? So here's $6.25 trillion that's owned by the Federal Reserve that they bought with money that they just made up. So one way we can get the debt down right away is just confiscate all of this, just cancel it. The Congress can do that. They probably, a lot of them, lose their funding and they wouldn't be there next year, or the next term, but they could do that. But they're not going to do that because they're controlled by these same people. Take a look at employment. So employment essentially spiked massively when we had COVID. And you can see that pretty much after the 2006, 7, 8 recession spiked, but grew back. Now, remember, again, unemployment rate, you have to take all of these numbers with a grain of salt because, again, Shadow Stats keeps track of the way we used to, we used to track these things. And if we were to use the Shadow Stats way, which counts people who after 1 year are still, because the workforce since COVID has come back mainly 100% for the women that were in the workforce. But for men, it has not come back nearly so much. A lot of men are still out of the workforce. People are doing these gig jobs where they're doing Uber or Uber Eats, or they're doing, Lyft, or they're making money on TikTok, or they're doing something. They call them gig jobs. So what's happening is a lot of that stuff is kind of off the books, and a lot of these people have part-time jobs. They don't have full-time jobs. A lot of people have sort of 2 or 3 part-time jobs. So if we were to look at it the way we used to look at it, about a quarter of the working force is out of work or doesn't work. And then I read an article in the New York Post by this guy, one of the co-founders of Home Depot, is saying that, socialism killed the motivation for people to work. Nobody gives a damn. And if you go to restaurants, you go out to restaurants and you see that certain sections are closed off because the wait staff didn't show up. Or I've been to a couple of restaurants and they put a sign on the door that says the entire restaurant is closed because the wait staff did not come in. Not that they don't have a wait staff, they have a wait, they just didn't come in. The whole restaurant's closed. And that's happened to me twice in the last 6 months or 3 months. So I don't know if that kind of thing happens to you, but you can see there's definitely problems in our economy. Now, that's where we are today. Let's talk about where we're headed. What can we expect for this year? Well, I can guarantee you we're going to have more overspending and fiscal waste. I mean, that's a guarantee, right? That's just the way it goes. Continued monetization of the debt, because we're always running a deficit. We don't have enough money to pay down the debt. We don't have enough money to really pay all the interest on the debt. So we just borrow more money and go into debt further for our debt to pay our debt. Continuing inflation, which is monetizing the debt. So, we're just going to continue to devalue the currency that you have in your pocket. And I feel really, really sad for, these next generation. Higher rates on bonds. We've already seen that. And so higher rates on bonds means that higher debt financing for corporations. So that's probably going to cause a further deep slide in stocks. You can see that in the employment market, where Google laid off 12,000 people, Microsoft has laid off 10,000 people, others are following suit because they see it's coming. They see this coming, and the main thing that they see coming are higher bond yields. Now, why is this important? Well, there's very few things that you can't describe with a lemonade stand. Okay, so let's talk about my lemonade stand. I make $100, whatever, a year, a day, a month, whatever. That doesn't matter. But I make $100. Let's say it's a day or a year. It doesn't matter. Quarter. And I have to buy my lemons and my sugar and all that stuff. So I have to spend $50 on those expenses. And then I had to have the lemonade stand itself. So I had to borrow the money for that. But I got a great deal because I'm only paying 2%. Well, that only cost me $10, a month to finance that. That's a great deal. So then my profits are 40. So if I've got a price earnings ratio, and I know I'm simplifying this overly, but if I have a PE ratio of 40 or 10, then that makes my stock roughly $400 a share, right? That's a great deal. Now, the problem is my debt service are bonds, and those bonds are going to mature this year, and they're going to have to roll over. Well, when they roll over, all of a sudden my debt service is going to triple. So I still have my income. I still have to buy my lemons and my sugar, and let's just leave inflation out of it. But my debt service all of a sudden tripled. So because of that, my profits are essentially cut in half. And because my profits are cut in half, my price earnings ratio, my stock is also cut in half. And so that's why a stock that was trading at 100 will soon be trading at 50 or close to it, especially in the NASDAQ. And you have to ask yourself, well, have rates gone up, and how much have they gone up? Well, if you were buying bonds down in here at the 1 to 2% mark, you're going to be up closer now to the 5 or 6% mark, okay? Because this is the base rate. All the other rates are based off of this. Does that make sense to everyone? I think you get it, because again, lemonade stands make a lot of sense, and it's just that simple in a lot of ways. Now, if we look at what's happened with mortgage rates, you can see it's affected the mortgage rates too. Mortgage rates jumped way up, and then they've come back a good bit, and it's probably because of the soft demand since rates have gone up. Certainly, new home sales have dropped. Here was that drop or the steep rise in the 15-year mortgage rate, very steep. And going back to what happened pre-2008, after the dot-com bust and everything, when interest rates were very low, guess what everyone was doing? They were locking in those 3-1 arms. Well, they weren't locking them in. They were riding these 3-1 arms. And then 2006, 7, 8 happened. And then all of a sudden, those mortgages, those rates tripled or more. And people just started walking away from them. And that's when we had, the 2008 crash. And that's when we had TARP and all the other stuff. So this is not the first time we've been through this rodeo, and I'm afraid we're going to go through it again, but at least this time we can see it, as we were able to see it last time. But if you look at mortgage applications, significantly down, okay, almost half as many, less than half, because of the higher rates. So that should translate directly into lower home prices. Okay, so all these things are relatively bad news for the economy, but for you as our personal investor, these higher rates present opportunities, because we used to sit in cash and earn nothing, right? Well, we don't want to get in stocks. We don't want to be in the stock market right now. I don't care what it is, because of what I've told you here with these higher rates coming down the pipe on the bonds. The companies are going to be paying more in interest. They're going to have less profit, and their stock price should likewise drop. But in the treasury market, we're starting to see some opportunities here in the T-bills and in the notes. So the T-bills are 1, 2, 3, 6, 12 months. The T notes are 2, 3, 5, 10 years, and then you go bonds above that. But if we look at those rates, we're getting some pretty good rates. If this is just as an example, but of the T-bills, like a 1-month T-bill over 4%, a 2-month T-bill over 4%, 4.25%. The 3-month, you can see the 6th month is paying the highest at 4.5%. But we know, like today, for instance, they're going to raise rates again. So they're raising rates roughly every 2 months. So what we've been doing as Magellan and for our clients is we're just rolling these 2-month T-bills. Every 2 months, we're just going to roll them. And, we're earning north of 4%, and we're going to continue to do that until the Fed stops. Once they stop raising rates, then we're going to go out longer. Now, today will give us a big sort of I guess a clue into what they're thinking of the future, because the first thing I'm looking for is transitioning from the 50 basis points to the quarter basis, the 25 basis points. That's the first transition I'm looking for. That might be today. That puts us on notice that they're close to the end, or that they're softening up. So that's a good sign, or it may be a good sign. Or it could be that they stick with these 50 basis points hikes, in which case that's telling us, hey, we're taking this inflation seriously, and I don't care about what the market's doing. We're going to go ahead and raise the rate to take care of inflation. And I wouldn't be surprised if that's what happens. So that would be a very long bet. Again, T-notes, 2 years, 3 years, 5 years, 10 years. Now I want to point something out here. If you look at the 2-year note, it's paying 4%. The 3-year note's paying less. The 5-year note's paying even less. And the 10-year note is paying least of all. Now what's happening here? Well, this is the classic example of inverted yield curve. An inverted yield curve happens when you're raising rates. Why? Because nobody wants to buy a 10-year or 5-year bond when all you got to do is wait for 2 more months to get a higher rate. Make sense? Look at that. The rates that are we're getting a higher rate on our 2-month treasury, right? The 3-month treasury, the 6-month treasury is 4.5, and that's higher than any of these. Almost a full point more than the 5-year. The 2 years paying almost a full point more than the 5-year. Now that's the 2-month, right, versus the 5-year. That's inverted. So that's the thing that we're looking for. But again, if we hang out here, these things are very safe, the safest investment on the planet, very safe, very liquid, and we buy them directly from the Treasury. And a large majority of our clients' money is sitting here now, waiting for this opportunity. And when does the opportunity come? Well, when price earnings rates get back below 20, and interest rates plateau, and then especially once they drop, because we've learned that once they drop, maybe a 1/4 point, 1/2 point, we're talking about drops now. That's when the market really drops, but then soon it recovers. So, hopefully history never really repeats itself, but it often rhymes, right? So I just want to thank everybody that's joined me today. And I hope that I've shed, some light on what we're doing here. If you have any questions, I'm going to check my Q&A here. I don't see any open questions right now, but now is your opportunity. I see Lynn. Hey, Lynn. And Alan, I see you. Hello, Ted. Good to see you again, as always. And all of our friends out there on the West Coast. Great to see you. Friends in Seattle. Great to see you there. Chicago. I see you. Hello, Houston. Hello, Chicago. Hello, St. Louis. Hello, Arizona. And what's that little town in Colorado? Buena Vista. Nice to see you. All right. Well, listen. No questions coming through. I just want to say again, I thank you very much, and I hope to see you at some of our events, chocolate tasting and chocolate making and cooking and ballroom dancing and golf and those type of things. I know many of you are out of the state, but hopefully we'll see you soon. Take very good care of yourself and have a great day. Bye-bye.